So tomorrow is one of the big days. It's the Federal Reserve releasing the new federal funds rate, how much they're hiking. General consensus is it's between 75 basis points and 0.5% or 50 basis points. This obviously going to have a big impact on the stock market and will signal to us what exactly is the intentions of the Federal Reserve. What are they planning on doing in the next months after this release? And one of the main things that we can sort of deduct is that if the Federal Reserve says it's 75 basis points, the general consensus is that stocks are going to go down. So we're going to see a decline in your main indexes like your S&P, your Dow Jones, and your Nasdaq. If the increase is less than 75 basis points, probably around 50 basis points, that means that it will probably indicate to the market that the Fed is starting to pivot, which means that the indexes will start climbing again. So we're going to have a bit of a rally. One of the things that the Federal Reserve uses to measure, obviously, if the interest rate obviously is going up or down is the inflation numbers, but there's a very specific one, which is the core PCE. It's not actually the CPI. So the core PCE at the moment is sitting at 5.1%. It did appear as if interest rates hikes did make an impact because there was a bit of a spike. As you can see on the graph here, we had a spike up until about March, and then suddenly we started coming down and we had a bit of a bottom at 4.7% in July. And then it still started going up. So our PCE is still increasing, which basically indicates that the interest rates hikes that has been done so far is not actually as effective, which basically could indicate that the Fed might hike 75 basis points and not 50. So that's one of the indications that we can see. The second indication is actually a graph that I came up with, and that's basically measuring the federal funds rate versus inflation. So in general, if you look at history, and I'll pull up another graph here, in history, the federal funds rate has always been higher than inflation, if you look at the last 70 years. So this graph basically, if the line, you'll see this is zero line in the middle. The zero line is when the federal funds rate and the inflation rate was exactly the same. Now you see in general, over the last 70 years, we've been above that line, which basically means that the federal funds rate has been higher than inflation. There's a very good reason for this. The reason for this is that the banks can still make money. The banks that obviously give out loans can still get more value back when the loans are repaid because of the interest rate being higher than inflation. We can see obviously after 2008, we've actually been below the line, mainly because of stimulus. Basically the economy, the Federal Reserve trying to stimulate the US economy to pick up again after the 2008 recession. But what we can see now is that we've had a major dip. The low point being, I think it's around about Feb, when we hit the bottom there, that we've actually, the difference between the federal funds rate and the inflation rate has never actually been that severe. And that actually means if that is sustained over a longer term, it actually means that the banks are going to start taking, they're going to start burning, because now it actually means that people taking loans are actually profitable and people giving loans are less profitable. This is now the banks. The repo rate is also, at the moment, the repo rate is below the core PCE. So even if banks borrow money from the Federal Reserve, they actually end up making money because the money that they pay back plus interest is actually worth less than they originally borrowed if you take inflation into account. So this might be one of the other reasons why I think that the Federal Reserve might actually hike more instead of less. So the next thing we can look at is the unemployment rate. The unemployment rate is a very interesting one. So there's a thing called the natural unemployment rate. The natural unemployment rate should be between 4 and 5%. So that basically means that, I'm just going to quote, this is Investopedia, about what natural employment rate means. And it says, the natural rate of unemployment represents the lowest unemployment rate whereby inflation is stable, or the unemployment rate that exists with non-accelerating inflation. So at the moment we're below that. This is a bit of a debatable subject. Some economists don't agree with the statement. But at the moment we're sitting at 3.5% unemployment, which is lower than this. And also one thing that low unemployment does, it's not just a number of how many people is unemployed that's looking for jobs. It is a bit of a measure of the health of the economy and what is the intentions of people and what's the state of the general population. It's a little bit more than just a number. And basically, also, I'm quoting Investopedia, in times of low unemployment, the demand for labor by employers exceeds the supply. In such a tight labor market, which is where we are now, employers typically need to pay higher wages to attract employees, ultimately leading to rising wage inflation. And rising wage inflation always leads to real inflation. So that's another reason why the Federal Reserve needs to increase 75 basis points instead of 50, because the unemployment rate, it almost seemed like it made a difference. Not the latest reading, the reading before that. Unemployment rate was like 3.7%, and then suddenly now the latest reading, it dropped down to 3.5%. So at the moment, we're not seeing the interest rate actually affecting the American consumer. Because remember, the Fed's main goal is to provide everybody with jobs and sustain a certain lifestyle for the American consumer. But at the moment, it's too hot. The American consumer has too much money, the economy is too fast, they need to slow it down because inflation's out of control. So they need to push unemployment up. And one way to push it up is to increase interest rates. Another one we also recently got is the JOLTS data. So that's the job openings. And the job openings has also, it sort of looked like it was, let me just get the right graph here. So the job openings actually looked like it was working. The job openings was going down, which basically means that there's more of a balance between jobs available and staff basically taking those jobs. But now the latest figure, it seems like job openings have started increasing again, which means there's a higher demand for jobs, but not enough people taking those jobs, which still means that the American consumer has the need to work is not there. So it's still, there needs to be a higher interest rate. So that's another reason to do a 75 basis point hike instead of a 50. Then there is one graph that is actually in favor of a 50 basis point hike, and that is the average hourly earnings. So if we look at this sort of fight between employers and employees or staff members on prices and trying to come to an agreement of what wages should be, that and unemployment and job opening, it's all a balance, and it gives us a sense of where things are. And obviously with post-pandemic, it's been very unbalanced. High demand for actual labor, but there wasn't a supply. There was no people actually taking the jobs. And that meant that wage prices just skyrocketed. But now we can actually see that the hourly earnings, I'll pull up the graph here, the hourly earnings is dropping, which is a good thing. That means that that whole balance is starting, it's forming a new equilibrium, which basically means that the interest rates, it might not be the interest rates causing this, it might just be that people are running out of money and taking jobs and taking whatever's available. So, but this is one of the few things that I could find that basically indicates a 50 basis point hike. And everything we've basically discussed now is inside the US. So obviously with inflation, there's two sort of major factors that determines inflation. One is what's going on inside the US, and another is what's going on outside the US. So inside the US, we can see that it's almost like the interest rate hikes is not actually impacting the consumer. It's not impacting the US economy. It's not slowing it down. So what about outside the US? And if we look at outside the US, there's obviously this movement of, because interest rates are suddenly at an all-time high, in like a 40-year high, investors are obviously buying dollars in order to buy bonds for very, very safe investments. And as we know, in the rest of the world, post-pandemic, they're having severe economical problems, plus the war is giving them energy problems. And we know the UK and the euro has lost its value. So a lot of people are buying the US dollar. And one of the big reasons is obviously the interest rates. So it might be that some of the interest rates, if you look at the PCE, not the PCE, the CPI number. If you look at the CPI number, I'll quickly bring that up. The CPI and the PCE, where we saw this reversal of CPI numbers, that might actually be the external changes of people buying the dollar. That's why the dollar index is also at an all-time high, and the other currencies are going down. So the interest rate hikes is not actually having the intended effect that the Fed is intending by affecting the consumer. All it's actually doing, it's making the dollar more attractive. So foreign investors are buying the dollar, and that is creating these changes that we saw sort of from March that's actually been helping inflation. But that has stopped. And the reason that stopped is because investors have stopped. They've done their trades. They've sold in the UK, in Europe, in Germany, wherever, even in junk bonds, and they've bought in the US, and they're done now. So the money has stopped flowing. The demand is no longer there. So now we're shifting from where inflation is determined by external factors to where inflation is actually now determined by internal factors. So actually now we're at a point where raising the interest rate might actually make a difference. And if it does make a difference, it's because the American consumer is actually slowing down. So that's just some of the interesting things that's happening right now. There's obviously the reverse is also happening. What happens if the other countries recover and funds start flowing the other way? Then we might see external pressures on the dollar. We also know that at the moment the oil prices are going up. So that's also external pressures, or not, it's just making the oil more expensive in general, which basically means inflation is going to go up. Especially now that the negotiations with Saudi Arabia is breaking down. We also know that there's a general sort of de-dollarization going on in the world, especially with the BRICS countries. There's also a lot of other countries that want to join the BRICS countries. Just to name a few: Algeria, Argentina, Iran, Saudi Arabia, big oil, Turkey and Egypt actually wants to join the BRICS countries. So they basically try to dump the petrodollar. And that's going to put a lot of pressure on the dollar, downward pressure. So it basically means that inflation in the dollar will become a big problem. So that might be another reason why hiking interest rates in the US might be a good idea, especially if you do 75 basis points. So my personal opinion is that the interest rate hike we'll see tomorrow will most likely be 75 basis points. The impact this will have on the rest of the world is unfortunately going to be very bad if this is the case. It just basically means that all other countries in the world will still need to keep their currencies attractive, so they will also have to raise their interest rates, but they might not be in a good position to actually do so. Like the UK, they recently had to increase tax by quite a bit. Now they also need to increase interest rates, so their consumers are going to be bleeding. just to keep the pound sterling attractive. Yeah, that's basically my sort of guess is that we're going to see a 75 basis point hike, which basically means if we see that, then the stock market will go down. We'll see the S&P, the Dow Jones, and the Nasdaq basically just slowly declining again. And yeah, we can basically place our bets accordingly. But this is Steve. If you like this content, remember to press the button. And if you want to see more, remember to subscribe. Until next time, ciao.